is the state of the market, state of the real estate market, Q1 2023 here. So I'm going to try to do, at least two of these a year. So the last one that I did, I believe, was June of 2022. Right now, we are in February of 2023. And, obviously it's a different state of the market right now. Different things are happening. We're seeing a really big surge of buyer demand in certain markets, in most markets, actually. Some markets more than others, but we are definitely seeing a surge in buyer demand. So trying to put the puzzle pieces together and explain it, and ultimately give an overview of the whole state of the market and why the market is as it is. Last year when I did this webinar in, what was it? It was June. And I said, the real estate market's not in a bubble. And a lot of people were like, you're crazy, you're insane for saying that. Are you sure you want to put your name on something like that? And really all I was just doing was just, kind of pointing out the data. And every single week now, we're seeing upward revisions of, analysts and banks and economists, housing forecasts, upward revisions. So I think the data is starting to come through and come clear. So that's the purpose of what we're going to do today. Hopefully you'll be able to share some of these charts with your clients, with your buyers, with your sellers, with your investors, and ultimately be able to kind of, show a picture of the market here. So let's start off with just explaining who I am and why do I follow all of this. So for those of you that don't know me, we have a lot of people on this webinar, but for those of you that don't know me, my name's Kyle Kovats. So the reason I follow all this data super close is, number one, I'm a real estate investor, and I invest in all different markets throughout the country. I invest in syndicates, multifamily syndicates in particular. As I always tell people, if there's a good syndicate that somebody's doing in Alaska and the numbers make sense, I'm going to invest in it. If there's a good syndicate, in Key West, Florida, I'll invest in it. Again, polar opposites of one another, right? Different, sides of the country. But I follow this data because I try to pick different markets where I'm seeing opportunity, and ultimately you say, hey, I think this is a good market to jump into. So number one, I have a company, Kovats Multifamily. Most of you who are watching this probably familiar with it. We buy apartment complexes anywhere between 200 to 300 unit apartment complexes, mostly in the South, Dallas and Houston in particular, as well as Phoenix. And then we syndicate those out to investors. So I'm not going to spend much time on that now. Most of you are familiar with that. And also, I'm the owner of Kovats Real Estate School in Bergen County, New Jersey. We're a pre-licensed school, and I try to provide, different insights to our students who are in class in regards to how they can use data to their advantage when they do ultimately get their real estate license. So that's the other reason why I pay really close attention to this. So with all that being said, let's dive into the, state of the market now. Real estate as a whole to begin with here. As you can see from this chart, it's really supply and demand. Like most markets in the world, real estate prices are driven by supply and demand. As you see here, you've had outliers from historical norms. Typically, there is always a direct correlation between supply and demand. As you're seeing here, though, we've had some outliers. Some outliers in the sense where we have still remained at really tight inventory, but in the latter months of 2022, we started seeing some price declines month over month. And the reason why we started seeing that is there was an enormous rate shock, a rate shock of the magnitude that we have not seen in a very, very, very long time. So what that ultimately resulted in is some outliers here. As you see, where the majority of these dots historically correlate, usually what we have is somewhere between 4 to 5% home inventory, and that ultimately results in roughly 0.5% month over month appreciation of home prices in the United States, which equates to roughly about 6% annually. Now, studies that go back to 1870 that track home prices from 1870 to 2015 will show you that the historical appreciation of home prices, accounting for volatility even, is 6.61% a year. And to me, the crazy part of that has always been that if you're buying an investment property and it's going to appreciate at 6.61% a year, most people buy investment properties with 25% down. So if I buy an investment property 25% down, and that's appreciating annually at 6.61%, I take that 6.61% and multiply it times 4 to figure out really what my net effective return from just appreciation alone is. And that comes out to about 26%. Now that's 26% a year, your leverage return, when you're not even accounting for cash flow or tax benefit as well that a lot of people take advantage of through depreciation and things like that. And this is the reason why real estate creates a lot of millionaires, the most millionaires of any asset class out there, because of the way in which we are able to finance that. with 25% down. Again, recognizing the benefits of 6.61% appreciation a year. So again, you get that nice leverage return that ultimately equates to just appreciation alone being roughly about 26% a year. Now, obviously, that will be dependent upon the leverage, but the majority of people buying investment properties, the median down payment is 25%. But as you see here, we're having outliers. Now, these outliers are starting to move further and further and further right towards the norm. As you guys saw, a lot of you to begin this, 2023 in January, purchase application data on mortgages began rising in November. And that's typically about, 90 days out or so where you start actually seeing, that come to fruition. And we saw that to really begin the year, where there was a big surge in buyer demand. The bidding wars were back. People were putting in bids on houses. They were waiving appraisals. They were waiving, home inspections outside of structural, environmental, and things like that. And it felt a lot like last year. And a lot of people are wondering where this is coming from. It's coming from a few sources that we're going to talk about here. Sources such as super, super low inventory. To begin 2023, it's only the second year ever where we started the year with under 1 million homes actively on the market, according to NAR, National Association of Realtors. Now, they deem active inventory to be both actives and under contracts, but it's only the second time ever. And we're going to talk about that as well. We're going to talk about the supply side of things. So the fact that so many homeowners have such low mortgage rates, which we'll talk about, the average mortgage rate nationwide right now, 3.47%, the average LTV on a home that has a loan on it, 42%, has led to people having such low fixed monthly payments on housing that it financially does not make sense for them to sell. And it's why that, typical traditional move-up buyer market is completely dead. And that's why we are seeing such low inventory, which is, really providing a lot of stability for housing. We're going to talk about a lot of these things though, but as you see here, historically, I wanted to show the relationship between supply and demand based off historic charts here. And what you see here is that typically it takes nationwide about 6.5 months worth of supply to see 0% month over month price increases. It's a completely and totally flat market. But historically, as you see right here, as highlighted here, from 1870 to 2015, the average appreciation of real estate, of housing, was 6.61%. If you scroll down a little bit further, if you go from 1950 to 2015, it was 7.1. So historically, you're seeing about somewhere between 6 to 7% appreciation of housing. Because again, housing is just supply and demand. People oftentimes try to overcomplicate things. Unfortunately, there's some people who aren't involved in housing and they view everything as a stock. Like one day you're going to wake up and you're going to sell your house and you're going to, become homeless. You're going to take your kids out of school, tell your wife, or your spouse that you're going to move just because you want to, sell now. No, it doesn't work that way. Life doesn't work that way. Housing is shelter. It's shelter at the end of the day. You don't just treat your house like you treat a stock, right? And more people, I think, unfortunately, need to realize that. And, they've, they have a little egg on their face, let's put it that way, from some of their calls that they had been making. Now, historically, I know we have people all around the country watching this. What does it take months of supply before you start seeing price declines? It's different depending upon where you are. Now, if you look here, San Jose as an example, they just need to see about a month worth of inventory until they start seeing price declines. Now, mixed bag here is the gray. This mixed bag, if you're getting in the mixed bag territory now, you're seeing price declines. That's usually where it's maybe increases, maybe decreases. If you're getting in the gray right now, you're seeing price decreases mostly because of the demand shock that we saw due to the rising interest rates. But other markets like Charlotte, historically, got to get up to like 10 months of, inventory before you start seeing price decline. So again, real estate is local at the end of the day. This chart that I was showing you before is based on nationwide data. This is more granular based on the individual markets in particular. Furthermore, we're still near historic lows as far as days on market. Now, we're up from where we were. We got as low into like the teens, into like 13, 14, 15 days on market nationwide average. Now we're at 26 days on market. So this chart here is to show you kind of historical norms of what usually, average days on market happen to be. Just back in as recently as 2011, we were all the way up to 96 days on market was the average days on market, right? As recently as May of the past year, we got down to 14. Right now we're at 26. It's higher than it was last May, but it's still super, super low. This is a chart that, furthermore kind of lays it out to you and just shows you in chart form here. As far as homes that are selling in less than a month, NAR's new data will be coming out soon, but back in May of 2022, it got as high as 82%. As high as 82% of homes that were listed were selling in less than a month. Historically, for context, on average, it's only 24% of homes will sell in less than in 1 month. Right now, as of the most recent data reflecting December 2022, 57% of homes are still selling in less than a month with an average of 2.2 offers on them. So it's still a super hot market in that regard. Super hot in the sense that, yeah, we're not seeing like the 20% year over year price growth or anything like that, but we have super low supply. And even though demand has been suppressed because of the rate shock, we are still seeing multiple bids on houses. And to begin this year, for those of you that are involved in the real estate business, in real estate sales, in brokerage, or you're an agent, right? You're seeing this right before your eyes as well. This is just a chart kind of laying it out here as well. For those of you who are realtors who don't follow NAR's stats and data, highly recommend doing it. They put out so much free stuff. Highly recommend checking out their stats and data and using it to your benefit. Furthermore, this chart is from today. This actually was uploaded today through Altos Research. This is based on nationwide inventory numbers. Nationwide inventory is continuing to decline. Continuing to decline. It fell another 3%. So typically, historically, every single year, inventory bottoms out towards the end of January and then begins to ascend up, during the spring selling season. The issue is inventory is continuing to drop at a faster pace. Usually the inventory drops slow down. They're actually accelerating a little bit right now. They've gone from, 1% decline in inventory, 2%, now 3%. It's concerning. And the reason why it happens to be concerning is because we came into this year as it being only the second year ever to have less than 1 million homes for sale between actives and under contracts. You'll notice the Altos data here, they only track actives, not under contracts as well. So their numbers will be shown as lower than NAR's data. But again, active homes that are on the market this week, 443,000. Super, super, super low. For context, in 2019, which was a 4-decade low in inventory at that time, we are 46% below the active inventories levels of 2019. And that was a 4-decade low at that time. You would have had to go all the way back to 1979 to see inventory as low as it was in 2019. 2023 right now, we are 46%, those 2019 inventory levels. So it's still super, super low. And if we still continue to see the surge in buyer activity and the number of active homes in the market can't substantially grow, it provides really a positive backdrop, I should say, for housing prices, in the sense that there's going to be stability there. There's not going to be crazy declines. And despite the rates going up so fast, that has suppressed the crazy price growth. We're seeing more of a balanced market, but if the rates come down, we'll talk about what the rates have to come down to see the real surge in buyer activity. It could pose a problem. Could pose a problem in the sense that we could start to see crazy price growth again if rates go lower and hit a certain rate point. We'll talk about that in a little bit. Now, this is Realtor.com's data reflecting, their late January report, which was reflecting all of December. And what it showed is that in December, new listings that came on the market were 21% less year over year. So while there might be more inventory on the market, the new inventory is not coming from new listings. It's coming from homes sitting on the market a little bit longer. There's a lot of home owners in this country, and the homeowners in this country, they're in fabulous financial shape. Their balance sheets are as healthy as they've really ever been. So they're saying to themselves, hey, do I really want to sell my house that I have a 3.5% mortgage rate on, and then buy a bigger house, take out a bigger loan at a 6.5% interest rate, and maybe double, triple, in some cases quadruple my monthly mortgage payment? Nah, I think I'm kind of cool just staying where I'm at. I can deal with this house. I don't mind this house. This house isn't too bad. And if I want, maybe I put an addition on. So we have, what we're calling like a seller strike, basically, where sellers are saying, hey, prices have gone up, interest rates have gone up. Why would I give up my current monthly payment on this house only to buy another house at a much, much, much higher monthly payment? This is what's keeping inventory really, really down. We're going to go over some really interesting stats on this and data on this and surveys on this in a little bit. I think you're going to find them quite interesting. Here is a perfect example of what I was just laying out to you. The Case-Shiller Index is probably the most widely cited index for home prices to show you where home prices have gone nationwide over a certain period of time. I'm going to give an example based off somebody who bought a house 5 years ago in 2018. So somebody bought a house 5 years ago in 2018. If you look at the Case-Shiller index, home prices from 2018 until now, until present, are up roughly about 50%, right? They're up roughly about 50%. This would mean that if you bought a home for $500,000 in 2018, that home now is worth $750,000 roughly. Furthermore, in bullet point 2 here, the average interest rate, the average nationwide interest rate on a home loan, on a mortgage in other words, right now, 3.47%. And again, that's not me making this up. It's right off the U.S. Bureau of Economic Analysis website through the U.S. Department of Commerce website, right? So you can find that, and we'll go over that chart in a little bit as well. So here's the example. You bought a home for $500,000 in 2018 with a 20% down payment, which would mean $100,000 down, and you took out a $400,000 loan at 3.47% interest, right? That would mean that your monthly payment between principal and interest is $1,789, right? Today, that house, fast forward 5 years of 2023 today, based off the Case-Shiller index, that home is worth $750,000. So if you wanted to buy your same exact house today with 20% down, that would mean you got to put down $150,000 now instead of $100,000, number one. But number two, that means you're taking out a $600,000 loan at 6.45% interest. That's roughly about the nationwide average. The nationwide average I saw today was actually 6.54, but let's use 6.45. That would mean that your monthly payment on your exact same home that you bought 5 years ago, your monthly payment on your exact same home that you bought 5 years ago, if you bought it today, you'd have to buy it for $750,000 with a $600,000 loan if you're still putting down 20%. And that would mean that your monthly payment at a 6.45% interest rate is $3,773, which is roughly $2,000 more per month, right? Now, what we know historically based on stats and based on, studies is that a move-up buyer traditionally will buy a house worth 50% more than their current home's value. In other words, if you have a $750,000 house, your traditional move-up buyer who's moving out of that house would be buying a house worth about 50% more, which would be roughly about $1,125,000, 1.125, right? Now, for that person to sell their current house and buy a house, be your traditional move-up buyer, buy a house for 1.125 with a 20% down payment, that would mean they have a $900,000 loan at today's interest rate of 6.45%. That would indicate that if they bought that house, their monthly payment would jump up from $1,789, right? From $1,789 to $5,659. It's an increase of your monthly payment by almost $4,000 in just principal and interest. That's not even taking into account tax and insurance. If you account for taxes and insurance increase, because for a bigger house, more valuable house, you're going to pay more in property taxes, it's going to cost more to insure it as well. That would mean that they would have to, if we're rounding numbers off, between principal and interest, $4,000 more alone. Add in tax and insurance, let's be just even friendly on this, and say the additional increase in tax and insurance is only an extra $1,000 a month. That would mean to be that move-up buyer, they'd have to increase their monthly payment by $5,000. That's $60,000 a year. And that's $60,000 a year that you would have to make. And to actually pocket $60,000 a year, you have to make around like $90,000 or so at work, because once taxes and everything are taken out, you're going to clear around like 60, right? So you can kind of see why this move-up buyer is kind of, it's dead. It's really on life support. And it's going to take a lot for it to come back. Because with what they've locked in, somebody bought a house just 5 years ago. If they bought it longer than 5 years ago, I mean, they're in even better shape, right? If they bought it just 5 years ago, again, this example, look at how crazy this example is. If they bought a house 5 years ago for $500,000, 20% down, that would mean a $400,000 loan. Their monthly payment, principal and interest is $1,789. That same exact house today is worth $750, which would mean a $600,000 loan if they're buying with 20% down, at 6.45% interest, that's a monthly payment in just principal and interest of about $2,000 more per month. These people they're not going to sell. They have so much equity built up in that house. They're living extremely comfortably. Why would they want to sell to be a move-up buyer and increase their monthly payment by $5,000 a month? It doesn't make sense. I explain this to people to say, any buyers you're working with that are like, we're waiting for the market to crash, right? I talk to some people like this every once in a while. Well, we're sitting on our hands or holding cash, waiting for the market to crash. Okay, well, when's it crashing? Tell me, because I want to know this. I want to know this because I want to take advantage of it as well. What data are you seeing that leads you to this? And I'm going to provide you with charts to show to them, because your buyers that are on the fence saying, we're going to wait, we're going to wait, we're going to wait. What are you waiting for? Because if you keep waiting, you're only going to hurt yourself. In fact, you kind of missed the window already. We saw the surge of buyer activity begin this year. I warned people last year when I did the webinar last year. I said, hey, I think these next 6 months are probably a great buying opportunity. I think that passed us by already. I think there's a good case to be made. That window's gone because the buyer activity surged again. And demographically, we have the most amount of 30 to 35-year-olds ever in this country right now. That's peak household formation age. That's natural demand for housing, all while we have the second lowest inventory of all time. So things aren't in buyers' favor right now. And from the buyer's perspective, it's hard to make a case that things will get better. If anything, things are going to get more expensive, perhaps. We'll talk about that in a little bit here. So getting more into this sellers on strike premise, this was a study done by John Burns Consulting. And he asked current homeowners. He said to a current homeowner, surveyed a whole bunch of them, right? He surveyed these homeowners and said, hey, if you were to sell your house today and you were to buy a house and take out a loan for an interest rate of over 5%, how many of you would do that? Only 36% of current homeowners said they would sell their house if it meant that buying a new house would mean buying it with an interest rate above 5%, just 5%. Furthermore, in the study, he also asked, if you were to sell your house today and buy another home, when you buy that other house, your interest rate on your mortgage is going to be more than 6%. How many of you would do it? Only 15%, only 15% of current homeowners said they would sell their home today if it meant buying a house with an interest rate in excess of 6%. The nationwide average interest rate today is February 13th, 2023. According to MortgageNewsDaily.com, the average interest rate today nationwide is 6.54%. Only 15% of homeowners said they would sell their home today if it meant buying another house with an interest rate in excess of 6%. Only 36% of current homeowners said they would sell their home today if it meant buying another house with an interest rate in excess of 5%. So this low inventory environment that we're in, it's here for the long haul. I think there's a very, very good case to be made is for the whole decade. Really. I mean, when you look at the demographic data, we'll talk about that in a little bit here. So furthermore, the lock-in effect. Depending upon the data source that you look at, somewhere between 63 to 73% of homeowners have interest rates below 4% right now, meaning that their interest rate starts with a 2 or a 3, or in some cases, believe it or not, I actually know somebody who has an interest rate that starts with a 1. It's crazy, but I do know somebody who has an interest rate that starts with a 1 on a mortgage. So that's completely and totally free money, which is insane to me, right? So that person should never, ever, ever sell that house, right? Keep it forever because that's free money. With that being said, when so many people have such low interest rates, we just gave the perfect example. That person who bought the house back in 2018 for $500,000 with 20% down. And if they just have the nationwide average interest rate of 3.47%, their monthly payment on that is super cheap. It's around, I think it was $1,789, right? To buy their same exact house today, just 5 years later, that house is now worth 50% more, $750. And if they were to buy that same exact house today, 20% down, they have to put down $150 instead of putting down $100,000, take out a loan for $600,000. And at today's current interest rates, their monthly payment's about $2,000 more a month in just principal and interest. So homeowners, their balance sheets are super, super, super healthy. everybody has locked in super low interest rates, number one. Number two, roughly 40% of homeowners, they don't even have a mortgage at all. So again, roughly 40% of homeowners don't even have a mortgage. And the ones that do have a mortgage, average interest rate nationwide, 3.47%. Average LTV, 42%. What does that mean? That means your average homeowner with a $1 million home has a loan on it of only $420,000. To size those numbers down, your average homeowner with a home worth $500,000, their average mortgage balance on that home is $210,000. Let me put this into context real quick. If you have a $1 million, a $1 million homeowner, he owns a $1 million home, let's say, at an average LTV of 42%, that would mean that that person has a $420,000 loan there. A $420,000 loan at 3.47% interest. That person's monthly payment between principal and interest is under $2,000 a month. So when I remember growing up, I used to think to myself, oh my God, they own a $1 million home. The $1 million homeowner today, because of how low interest rates were and everybody refied, has a monthly payment on their loan, on average nationwide, below $2,000. It is an insane thought to think that. Those people, they can't, $1 million homeowner, very likely, I know at least in North Jersey where I operate here, $1 million homeowner who has a mortgage balance of $420,000, which is a nationwide average, LTV-wise, and they have the average nationwide interest rate of 3.47%, they cannot sell their home in North Jersey and rent a 2-bedroom apartment in the same town for the same monthly payment. It's insane when you think about that. This is why inventory is going to stay super, super, super low. A lot of things would have to happen for inventory to really grow sizably and even get back to 2019 inventory levels, which again was a 4-decade low. It could get back there, but again, that was a 4-decade low at that point. So the inventory being low, if you guys take one thing away from today's webinar, it's very likely inventory for the whole rest of this decade remains super low, super, super low because of the backdrop that we have here. Here's the data. Again, nationwide average interest rate on a home loan, 3.476%. Let's just round it off and say 3.47. And the other thing too, you might be wondering to yourself, well, maybe the inventory comes from foreclosures like it did in 2008. Well, that's not happening. Why? Because everybody who took out loans, not everybody, but majority of people who took out loans over the past few years, they took out home loans and they were extremely, extremely, extremely healthy as far as borrowers' profiles are concerned. As you see here, leading up to 2008, we had a lot of people getting loans who weren't as highly qualified as they are today. In fact, a lot of people who were getting loans leading up to 2008 with those teaser rates, it was known that they couldn't afford the recastment of those payments when they recast 2 years later, which is how you get movies like The Big Short and stories like that, right? Now, average interest rate of a borrower taking out a loan today, 768, according to Black Knight. You can look up Black Knight. They have really good data. That got as high as 788 in 2021. The average credit score of a borrower at points in 2021 was as high as 788, super high credit score. The most recent data, 768. Not as high as it was in 2021, but still pretty damn high. So super, super healthy credit profiles of the borrowers who are taking out loans today. Furthermore, on top of these credit profiles, they're not even over leveraged. It's not like they're taking out these crazy high loans. They're not over leveraged at all. The average nationwide LTV for homeowners that have a mortgage on their house, remember 40% of homes don't even have a mortgage. But for homes that do have a mortgage, the average LTV is 42%, which again, here's the math on it, right? Your average homeowner with a $1 million home has a monthly mortgage of $1,879 between just principal and interest. That's if we assume a 3.47% interest rate on their loan and that they have 42% LTV. In other words, what this shows you here is that a $420,000 loan at 3.47% interest would indicate a monthly payment between principal and interest of $1,879. So again, between just principal and interest, your average $1 million homeowner, has a monthly payment of principal and interest of just $1,879. And again, to put this into perspective, your homeowner who's buying a $500,000 house today with 20% down, nice down payment, right? 20% down. They're taking out a $400,000 loan at 6.45% interest. Their monthly payment is going to be more, significantly more, than that of your average $1 million homeowner. It is insane when you think about that, right? Again, I just want to put this all in the context for you guys here. Again, just further laying into this theme that inventory, it's going to stay super low. So if anybody's waiting for this super high rise in inventory, they're going to have to build. I don't know where they're building, right? It seems like there's more and more red tape every day to start building. So God bless if they can keep building somewhere, because it's not exactly easy to build these days. The soft costs alone up front make it a little prohibitive. And furthermore, tappable equity of homeowners. Let's go over this here. Let's define what tappable equity is. Tappable equity means how much equity could you take out of your home and still retain 20% total equity position. The amount of tappable equity in U.S. homes for homeowners combined is $11.5 trillion. $11.5 trillion. That's not total equity. That's the amount of equity they could pull out of their home and still retain 20% total equity in their home. In other words, an 80% loan to value ratio, which is typically deemed healthy, right? Let's put that into context here. Look at the GDPs of all the countries worldwide. U.S. homeowners have more tappable equity in their homes than every single country on earth except for the United States and China. In fact, here's some, European superpowers, right? Not superpowers, but powers, legitimate countries. Germany, France, United Kingdom, Spain. If you add up their combined GDPs, they're just about as strong as United States homeowners. That is how healthy the balance sheets are of American homeowners. And what's unique to America that is unfortunately they don't have in Europe is fixed interest rates. Throughout Europe, homeowners' interest rates are always adjusting. Always. They don't really have fixed loan products. They're always adjusting perpetually. So when their interest rates go up, they could see a lot of trouble in their real estate markets. Whereas us here, our homeowners, again, average interest rate, 3.47% nationwide, pretty damn strong. Again, LTVs, loan to value ratio, super low. A lot of equity built up in houses. This is why the backdrop of this is so much different than what it was. In 2008, you had all these fugazi loans, as I always say, right? What do I mean by that? You could breathe in a mirror and get a loan. You had people taking out loan after loan after loan after loan, buying houses. The payments were going to adjust in a couple of years. The interest rates were going to shoot up, and it was already known they could barely afford the teaser rate for the first 2 years. The thought was they would sell in 2 years when they couldn't afford that monthly payment, for the purpose being that they would just cash out, right? Well, unfortunately, that didn't work out. But luckily for us right now, post 2008, all the regulations that were put in made lending standards strict. So people who have loans now, they have really, really high quality loans. These banks have high quality loans on their books. And if somebody does have job loss, if somebody does get into financial trouble and things of that sort, they could just sell. And the reason they could sell is because they have so much equity built up in their house. Now, they might restart somewhere over in like a smaller rental or something like that, but they could sell their house. There's not going to be a lot of forced credit selling. This further kind of, dives into that, right? Look leading up to 2008. This chart here is from Logan Motoshami. He is a tremendous housing economist through Housing Wire. I'll have his information at the end here. But if you don't follow him, you should certainly follow him. And his service through Housing Wire is tremendous. It's so good. I cannot recommend it enough. I get a lot of data from him. He's super interactive, and he's really he's a wealth of knowledge. Somebody very, very worthwhile following. But as you see here, leading up to 2008, you had foreclosures rising, bankruptcies rising. You had forced credit selling, and a lot of it. What do we have now? We have almost nothing. Bankruptcy is way down. Foreclosures way down. In fact, the recent data shows us that in the prior month to end 2022, the last month to end 2022, post the lowest delinquency rate of all time in United States history. That's what you see here. Again, this data here is off Bill McBride's Substack called Calculated Risk. I highly recommend subscribing to that as well. These people don't pay me, by the way, to put their information out there, but these are data sources that I use that I think a lot of people, would really, find value in using them as well. I want to say Substack is only like $5 a month or something like that. But this data, again, comes from Black Knight, and I got this through Bill McBride and his Substack here. But delinquency rate for all loans, 3.45%. It's the lowest level in the history of them ever surveying this. They started surveying it in 1979. We have the lowest delinquency rate on loans of all time. Again, we have the healthiest balance sheets, near the healthiest balance sheets of all time for United States homeowners. This is why people are like, I'm a good, I'm not going to sell. I'm just going to hold. I got a nice fixed rate payment. It's low. It's cheap. Why would I sell and just, move up to something else that has a significantly higher monthly payment? I'm comfortable where I live, right? Here's another thing that shows you, puts it into context. This is a chart from the St. Louis Fed website. And what it shows you here is mortgage debt service payments as a percentage of your disposable personal income. Near all-time low. Monthly mortgage payments as a percentage of your income, so this way it provides good context, as a percentage of your income is near all-time lows. Now, for people who are taking out loans today, you might say, yeah, but not for them. They're such a small portion of the total homeowner market. It's a very, very small portion of the total homeowner market, people who are taking out loans today, right? But this aggregates everything together. So mortgage debt service payments as a percentage of total disposable income, super, 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 super low, right? Near all-time lows. The all-time lows were set in 2021. We're still near all-time lows, though. So when you look at this, you put this all into context, you got to ask yourself, well, where's the selling coming from? I don't have the answer to that one. I'm still trying to figure out where the inventory is coming from. Again, this is why I'm under the impression, and the data kind of backs it up, that we're going to be in a super low inventory environment for a very long period of time. And I thought this was a timely chart to put up here as well. This was a chart done by John Burns Consulting. What he did is he looked at it from December 21 until June of 2022, when rates got to about 6.25%. How many less households could afford a $400,000 loan? And what it showed is that 16.5 million less households could afford a $400,000 loan over the course of just 6 months, from the end of 2021 in December until June of 2022, when rates really shot up, and they shot up fast, and they shot up, not only just fast, but they went high as far as where they were coming from, right? Fastest rise in rates that we have ever seen. 16.5 million less households could afford a $400,000 loan. So what he studied is he said, all right, well, if rates go down to about 5%, 4.99, how many more households would be able to qualify for a $400,000 loan? And the answer is 4.6 million more households. And furthermore, we actually saw this occur. If you guys remember back to like July, August 2022, remember rates went down and it felt like there was a little jump in buyer demand? Seasonally, I know in New Jersey at least, we're kind of in a little bit of a lull, towards that time. It's the end of summer. People are, enjoying their last few weeks down the shore and things like that. But there's a little bit of a, kind of demand rush when those rates got down. What the data actually showed nationwide is the sales rate from August 22 to August 21 was only 0.1%, only 0.1% off of the August 21 sales pace. And August 21 was like towards like peak frenzy, right? So that kind of shows us, and that kind of indicates to us that if rates can just get to about where they were at that time, 5.25, 5.5, if rates just get to that 5.25, 5.5 ballpark, there's going to be a real surge in demand. So if you think you're seeing a surge of demand right now, the data is showing us that if rates get back down to 5.25, 5.5, you're going to see a real surge in demand, right? Because we already saw it. And here's a chart kind of laying that out to you, right? So again, what this chart shows you is that, in July and August, when rates did dip into the low fives, sales grew by roughly 18.5% in just 1 month. And again, we were only 0.1% off the August 21 sales pace in August 22. All it took was rates getting into that 5.25, 5.5 ballpark. So whenever that happens, that's a little trigger for you. That's an indicator for you. When rates start creeping down towards that range, I don't know when it's going to happen, but when it does eventually happen, that tells us that there's going to be a lot more buyers who could afford, homes. We know that if rates go down from 6.25 to 5%, 4.6 million more households could afford a $400,000 loan. So again, this kind of leads to why there is that surge in demand at that price point, at that interest rate. And here's a nice chart also put out by John Burns Consulting showing you what the difference is between when rates peaked in November of 22 at about 7.3%, if they were to go down to 6%, which they were, at 6% about, a month ago or so. This is making the assumption that you're buying a $475,000 home with a 5% down payment, right? So November 22 monthly payment, again, this is just principal and interest on a $475,000 loan with 5% down was about $3,000, about $3,100, right? Now, if you were in a market that saw zero price decline until now, let's say rates now were 6%, that would save you about $400 a month. If you're in a market that saw 5% declines, that would drop your monthly mortgage payment by 17% based on the rates going down as well. If you're in a market that saw a 10% price decline, drop your monthly payment by 21%. And if you're in a market that saw a 15% price decline between when rates were 7.3 to when they get to 6%, what that would save you on your monthly mortgage is 26%. This is a good chart just to show you, what would occur, what would the savings be between interest rates and overall in monthly payment based on if rates go from a certain level to a different level and there are price declines as well, or just no price declines at all here, right? This is a good chart to, perhaps show clients and show them, what the savings could perhaps be. And again, John Burns, another great source that I highly recommend following. And buyer surge, right? We saw a buyer surge to start the year. At the beginning of January, this is for the second week of January, we saw mortgage purchase applications rise by about 25% week over week. It was more than we even seasonally see. And year to date right now, as of the end of last week, mortgage purchase applications, they're up 15% year to date to begin the year. So we definitely are seeing a surge. It'll be interesting to see this data as it continues to come out week after week as the rates have gone up. About, I guess, a week and a half ago, rates got as low as 5.99% nationwide. As of today, as of this recording, they have gotten up to 6.54%. So that'll be interesting to see and follow, what does that lead to as far as mortgage purchase application data is concerned there. So overall, we are up 15% year to date. So if you're seeing a surge in buyer demand and it's a little earlier than typically you're seeing in your market, this is why. Now, next is the question I think a lot of people are wondering, myself included. When will rates come down? When will rates come down? So I wanted to first put this into context for you based off historicals. So historically, what you can just do is take your 10-year treasury rate, add 1.7% to it, and that's your 30-year fixed rate loan, interest rate, right? That's what it is historically. Right now, spreads are blown out. They're completely and totally blown out, right? Before this recording, I was checking CNBC and I saw that the 10-year treasury was trading around 3.7 today, which means that basically with nationwide average interest rates at 6.54, instead of it being the 10-year treasury plus 1.7%, it's closer to the 10-year treasury plus 2.7%, actually a little bit more than that, but let's just for round even numbers sake say 2.7%. The spreads are blown out. Now, why are the spreads blown out? A couple of reasons. A lot of people speculate. Number one, people think that sometime in the next 2 years, rates will come down. And furthermore, the Fed is kind of saying that as well, in their dot plot, saying that over the next 2 years, rates will come down, right? The thing is on residential mortgages, there's no prepayment penalty on a residential mortgage, right? So if I take out a home loan to buy 123 Main Street today for $500,000 and my interest rate is 6.5%, if a year down the road, rates are at 5%, I could refi. And do I get penalized for doing a refi? I don't. I would not be penalized. So for that reason, they say typically a bank needs to hold on to a loan for like 6 to 8 months just to even break even by itself. So they want to be compensated for the risk that they're taking. They could perhaps lose money on that loan if somebody does refi too soon. Another way we can kind of know this is that in commercial loans that do have prepayment penalties, such as things like yield maintenance, people are getting quoted interest rates in the lowish fives. As recently as a week ago, I was speaking with somebody who got quoted 5.18% on a commercial loan because there's a prepayment penalty, so they don't have to worry about the prepayment risk. So the spreads are more in line there because they don't have to worry about that prepayment risk, whereas they do on the residential loans, so the spreads are a little bit more blown out. There's other concerns that the Fed is going to start, instead of just letting the mortgage-backed securities roll off their balance sheet, they'll start actively selling them. I'm a little bit skeptical about that. The reason is because the Fed really didn't start buying mortgage-backed securities in mass until around 2008. And if you look historically at this chart here over time, this chart goes all the way back to 1971. What it shows is that historically, typically, roughly, you take the 10-year Treasury, you add 1.7%, and that is your average spread on your interest rate. So with that being said, once the market is comfortable that the Fed is going to pause their interest rate hikes, those spreads should start coming back in. Now, it's kind of baked into the market that the Fed is going to hike again in March. And then the question is, do they hike in May or do they pause in May at the May Fed meeting? If they pause in May, then the spread should begin to contract and should begin to come in, right? However, with that being said, the mortgage market is not going to react until they know for sure. And then eventually, sometime down the road, it'll happen. We just don't know when. Sometime down the road, when the Fed does begin actively cutting interest rates, that's when those spreads should really come in, more towards historical norms of 1.7%. We just don't know when these things are going to be. We'll talk in a little bit what the bond market is pricing in. And again, these charts are, as of when I made these charts, which were the end of last week, but we know what the bond market is pricing in, but what they price in versus what happens could be two different things. As I think back right now, I was actually looking the other day at the Fed dot plot as of like early February last year. The Fed dot plot, the most recent one at that time, was put out in December of 21. And the Fed dot plot, the Fed members said, we're going to get our Fed funds rate up to about 1%. That was the average on there. Well, we ended the year at about 4.5%. So that even their own projections were way off, right? So it's the bond market, the Fed could say what they want to say, but ultimately, we'll see what they do. I'll just show you what they're pricing in now. With that being said, when the Fed does pause, as I said, when they do pause, the spread between 10-year Treasury yield and 30-year mortgage rates should begin to come in, which therefore, what does that mean? That means that mortgage rates come down. Once they start cutting, though, that spread should really come in back towards historical norms of taking the 10-year Treasury, adding 1.7% to it, and that being your 30-year fixed rate mortgage rate. So with that being said, once the Fed does pause, how soon do cuts come? On average, over the past 30 years, about 8.7 months after your last rate hike is when you start seeing the Fed actively cutting rates. And only once over the past 30 years has it taken them more than 7.6 months to start actively cutting. And I'll show you in a little bit what the Fed is pricing in here. So this here is the Fed's projection of their median Fed funds rate. As you see for 2023, they're projecting, their dot plot is showing 5.1% median Fed funds rate. And the Fed, what are they saying they want to do, right? You guys, anybody who follows this stuff, you see the Fed saying, we want to stay higher for longer. We want to be sufficiently restrictive and things like that, right? So if they're projecting their rate for the year, their median rate to be 5.1%, what do they deem to be, kind of sufficiently restrictive, as they say? Well, let's just look at this. What are they projecting their core PCE, the core PCE to be for 2023? 3.5%. That kind of leans in and tells me that they believe sufficiently restrictive is 1.5% roughly above core PCE. The reason I bring this up is because a lot of people think and say that you need to see a recession for them to cut rates. That's not necessarily the case. The reason why is because core PCE could come down without a recession. And if core PCE does come down, let's say perhaps to 3% by the end of the year, the Fed could say, hey, we think that sufficiently restrictive is 1.5% above core PCE, so we'll move our Fed funds down to 4.5%. I'm not saying they're going to do this, but they could do it. How do I know they could do it? Because they say they want to be higher for longer and sufficiently restrictive. So if they're projecting core PCE to be 3.5% in 2023, and they're projecting their Fed funds rate to be roughly 5%, that tells me that sufficiently restrictive is 1.5% above core PCE, right? Now, their target for inflation is 2%. How long does it take to get there? Who knows? I don't know how many people know this either, but I learned this the other day, actually, on an Odd Lots podcast with Joe Weisenthal, if anybody listens to that, and Tracy Alloway. But back in 2012 was the first time the Fed actually came out and set a target, and they set that target at 2%. So I thought maybe the target was just always out there. It wasn't. It was only set about 11 years ago. So could they change that? They could. Who knows? I don't think they will. I think they'd lose some credibility if they did that. But I guess they could, in theory, always change that. There's reason to believe that, there's people saying, hey, lack of globalization, aging population as far as boomers and, exiting the workforce, tighter labor market. Maybe there's reason to move that projected up or that expectation up. Who knows? Anyway, one thing I can tell you, though, based off their own projections, they say they want to be sufficiently restrictive. So if they're projecting core PC to be 3.5, Fed funds to be roughly 5%, sufficiently restrictive in their eyes seems to be 1.5% above core PCE, right? And take a look at this. This compares Fed funds, the Fed funds effective rate over PCE. So in the 21st century, which is 2000 to present, right? We've gone through 277 months. Only 70 of those months did the Fed have positive real rates. In other words, where Fed funds was above core PCE, right? And furthermore, post 2008, we've only, up until this month, post 2008, we've only gone a year total of real rates. October 2018 to September 2019, post 2008. So post 2008, the past 15 years roughly, we have only gone a year with positive real rates. Furthermore, again, they say they want to be sufficiently restrictive, 1.5%, which again, apparently their definition is 1.5% above core PCE based on their projections. Only 42 of the total months of the 21st century have seen real Fed funds rate positive territory of 1.5% or more. Right? So the question is, how long will they hold that? How long can they hold that? The bond market kind of thinks they're bluffing a little bit, and I trust the bond market personally. I think they're the smartest guys in the room, myself. But let's show you what they think. So here's what the bond market thinks. What's the bond market pricing in? The bond market's pricing in, they're going to do a hike in March and then pause. Now this chart, again, is obviously subject to change. This is as of last week. Again, it could change this week, right? It's as of last week. The bond market's pricing in, they're going to hike again in March and then pause, right? So this is indicating a hike in March. Pause, 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 pause. And the first cut comes in November of 2023. They believe in November of 2023, the market is betting on the Fed cutting by 25 basis points. The following meeting on December 13th, 2023, my sister's birthday. Shout out to my sister Christy if she's watching. They believe they're doing another 25-point basis cut at that point in time. So the bond market's pricing in 2 cuts in 2023. Again, obviously subject to change. And it could have changed today for all I know. I haven't looked today. But this is as of last week here. So again, when you look back at this data here and you say to yourself, well, in the 21st century, there's been 277 months, of which only 70 months did we have positive real rates. Only 42 of those months did we have positive real rates above 1.5%. And only a year total post 2008 did you even have real rates at all. We don't think you're going to keep rates this restrictive forever. Furthermore, here's no secret. What happens in November of 2024? A presidential election, right? You should go back and look at this chart historically, what this chart does going into a presidential election year. I know a lot of people say, well, the Fed's independent of the government, blah, 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 blah. If you don't think the Fed feels pressure from the government in regards to, trying to basically cause financial harm leading into a presidential election year, especially a re-election year, you're a little naive, I think. So you should do yourself a favor and look at this chart. Look back at this chart into presidential election years, in particular re-election years, where an incumbent president is running again. Take a look at that chart and see what happens. All right, so here's another chart kind of on this. So what is the bond market pricing in general moving forward? So from June 23 to December 24, they're pricing in 200 basis points total worth of rate cuts. Now that indicates that the bond market doesn't think we're going to get a recession. They think we're going to get that soft landing. They're pricing in what they call that immaculate disinflation, where we have disinflation without seeing a recession. Again, it's rare that that would occur, but that's what the bond market thinks is going to occur. And to be honest, things are kind of looking that way, right? However, with that being said, as they always say, right? Every recession always looks like a soft landing at first until it's not. So I'm not going to opine on this in regards to like, do I know exactly what's going to happen? No, I'm not that smart. I don't pretend to be that smart, right? I don't pretend to be that smart at all. But generally speaking, they are pricing in 200 basis points worth of rate cuts between June of 23 and December of 24. However, if there is a recession, typically every single recession on average, the Fed will cut interest rates by 350 basis points, in other words, 3.5% in the first 18 months. So depending upon what happens, does a soft landing occur? Is it a hard landing in a recession? Depending upon what happens, will determine the track of interest rates overall. Now, furthermore, what does Mortgage Bankers Association of America believe? They have put out their projections for 2023 and 2024 for that matter. And what they show here is that they believe by the end of 2023, we're going to have 5.2% mortgage rates, 30-year fixed rate loans by the end of 2023. They also believe that by Q3 2024, we're going to see 4.4% 30-year fixed rate loan interest rates. Q3 2024 ain't that far away. Q3 2024 starts in July of 2024. That's what, 17 months away at this point? That's not that long away. This would be a good chart to show to buyers, to say to them, hey, maybe it makes sense if you're looking to buy to do an ARM, purchase with an ARM, lock in that lower fixed rate of interest for the first, let's say it's a 7-1 ARM, for the first 7 years. And then refi. If rates do in Q3 2024 hit 4.4 or even 4.5, refi at that point. Take advantage now while the rates are higher. And yes, there is a surge in buyer demand, but could you imagine the surge in buyer demand if rates get to 4.4%? And we know that there are the most 30 to 35-year-olds ever in this country's history right now, which is peak household formation age. Could you imagine the surge in demand then? Why not take advantage of the market now? And I know it's a corny term, but I actually like the term. Why not date the rate, marry the house? And then you can refi. Refi when rates do go lower. 7-1 ARM, 10-1 ARM. Look, odds are sometime over the next 7 years, rates will be lower than what they are today. I think it's a good idea. I think it's something worth talking about with them and have them talk about with their, mortgage professional as well. And pregnancy data. I wanted to get into this. Why? Why are we talking about pregnancy data? The reason we're talking about this because when people start having kids, they start buying houses, start forming households, right? So what are some stats on this that we need to know? First and foremost, the average male getting married today is getting married about 30 years old. The average female, about 28. This has led to a delay in household formation. In 2021, the average age of a first-time home buyer was 33. In 2022, we set a record for the oldest median first-time home buyer age of 36. It's delaying household formation. Not only that, houses got so expensive, people needed to work a couple more years to buy a house. So the median age for a first-time home buyer over the past 2 years, 2021 and 2022, was between 33 and 36, right? If you look at this here, based on pregnancy data, the most amount of births right now in the country are coming between women between the ages of 30 and 34, with the median age being 30. On average, the data shows that a married couple will have their first child 3 years after marriage. So if the average male is getting married at 30 and the average female at 28, that would mean that the average first child is coming at 33 for a man and 31 for a woman. This actually directly lines up with some of the demographic data that we're going to go over in a little bit. Do you know that in 2023, the most common age nationwide is 33 years old? And I'll talk about I get excited about the demographics. Talk about that in a little bit here. So look at this. Right here, this is the age distribution in 2021. I'm going to relate this to 2023 in a second here. But we have the most amount of people ever in this country right now between the ages of 30 to 35. And 30 to 35 is peak household formation age, right? Again, in 2021, your median first-time home buyer was 33. In 2022, that was 36, the oldest ever on record. Here's the thing. Take a look at this. Look at the most common ages in 2021. Therefore, just add 2 years to these, and that's 2022. Do you know, and you can see it based on this chart here, the 10 most common ages in this country? Every single one of them this year is between the ages of 29 and 38. The 10 most common ages, the most amount of people of any age in this country right now is 33 years old. The second, 32. The third, 31. The fourth, 34. The fifth, 30. What does this show you here? What this shows you here is that everybody, well, not everybody, right? But the most amount of people in this country, they're all between the ages of 30 and 34. The number six most common age, 35. The 6 most populated ages in this country, every single one of them is between the age of 30 and 35. Why is this important? The reason this is important is because this is peak household formation age. If median first-time homebuyer was 33 in 2021, it moved up to 36 in 2022. The 6 most common ages in this country are between 30 to 35. The 7th is 37. The 8th, 38. The 9th, 36. The 10th, 29. And Gen Z, while not as big as millennials, they're not that small either. The US has really good demographics. And it's, estimated that we have a shortage of housing supply nationwide of somewhere, around like 5 million homes. Some people say 3 million, some say 4, some say 6. Historically, you see not historically, I should say, top data sources show it to be somewhere between 4.5 to 5 million homes shortage that we need in this country. The problem is majority of construction workers, which we talked about in a webinar back in June, majority of construction workers, the large majority of them are in their 50s. They're retiring. Unfortunately, the younger generation doesn't want to do construction. So we have a real lack of labor there. So it's getting more expensive to build. Government regulation is higher. It's more expensive to stick a shovel in the ground. They're building less. What they are building, the only thing they can afford to build is things that are luxury to make their money back. But anyway, getting into this here, just getting back to this demographics, we have the most amount of people ever between the age of 30 and 35 in this country right now, peak household formation age. So we have the highest built-in natural demand meaning just people who are breathing, highest ever built-in natural demand, all while we have the second lowest supply ever of homes for sale. And it doesn't look like that inventory is growing, right? It looks like we have a really, really low inventory environment for a rather long period of time. Furthermore, this super low inventory, the second lowest inventory of all time, this is all while we had a huge demand shock. So you would think that if mortgage purchase applications fell off a cliff, we are already below 2008 mortgage application data. 2008 was a great financial crisis. We are already below 2008 mortgage application data, and we can't get inventory up despite that enormous demand hit because homeowners aren't selling. Again, new listings are down 21% year over year. Homeowners in such great financial shape that they're saying, I'm not going to sell. I'm just going to sit on my hands. I'm going to hang out. I like this house. Like my mom's a perfect example, right? My mom bought her house in 2000 for $229,000. Her house is probably worth somewhere around $600,000 today. Her monthly mortgage on that house for principal and interest is about $650. Is she ever moving? No. The only way she's moving out of that house, I hope my mom lives till 150, is she's going to get carried out of that house in a box when she's 150 years old. She's going to find a way to have her dog live till 150 as well, because she loves that dog more than she loves me. I can tell you that much. So anyway, with that being said, she's not ever going to move. But it's not just my mom. There's so many people like that, right? So we had this waterfall drop in demand, right? And it couldn't even get inventory that high. We have the second lowest inventory to begin 2023 than we've had ever to start a year. And the lowest ever was 2022. Despite all this, inventory hasn't really grown sizably at all. So demand might have already bottomed out, but supply didn't grow. That's a problem. That's a problem in the sense that inventory is so low that if demand does start picking up more towards historical norms, that inventory is going to shrink really quickly. And again, housing, it's just supply and demand at the end of the day. Look at this. It shows you nationwide sales rate, annualized sales rate. We're down at about 4 million home sales a year. Let's go back to 2008 here. 2008, same amount, demand-wise, right? About 4 million home sales. That was the great financial crisis. And again, homeowners weren't nearly in as healthy position back in 2008 as they are now. Credit scores, LTV, nested equity, everything, right? Super, super low monthly payments. We have gotten such low demand because of that rate shock, and it hasn't even grown inventory. The crazy part about this, we went down to 4 million home sales annualized, and we still have the second lowest inventory of all time. And when you think back to 2008, I'll show you a chart in a second on this. If you go back to 2008, according to NAR's data, we had 4 million homes for sale around like 2008 to 2011, in that ballpark. The market bottomed out in 2011. 4 million homes in the market. Now we have under 1 million, the second lowest of all time. So again, we already are at the same sales rate as a great financial crisis, global financial crisis, right? Whatever you want to call it. But inventory hasn't grown. So you got to tell me, where's this inventory coming from? Personally, I'm sorry, I just don't think it's coming. We're going to have a super low inventory environment for a very long period of time. Take a shot every time I say that. You're going to be, very intoxicated soon, right? So I've said it a lot here. Take a look at this. How much demand is on the sidelines? Because we know the sales rate's down, mortgage applications are down. How much demand is on the sidelines? A lot. This is the number of single-family homes sold to people between the age of 25 and 54. Look at this huge drop in demand. Enormous drop in demand here because there's such low inventory. There's nothing to buy. Such low inventory. There's people that need to buy. Remember, there's roughly about 3.4 million people more between the ages of 30 and 35 now than there was back in 2008. Despite all of that, and again, that's peak household formation age. Despite all of that, we're in a situation right now where inventory is still near all-time lows, second lowest all time. Again, the inventory story is going to be a story for us for the whole rest of the decade, in my opinion. And if you look at people between the age of 25 and 54 from 2011 to now, I use 2011 here because that's when the market bottomed out. We have 3.1 million more people now between the age of 25 and 54 than we had in 2011. Between 30 and 35 alone, though, again, peak household formation age, we have 3.4 million people alone more. So again, there's a ton of demand waiting on the sidelines. And we saw back in August, when those rates get to 5.25, 5.5 in that range, they come out of the woodwork. So the question is, can your buyers take advantage of the market before that happens? Because the market's getting crazy again already at interest rates in the sixes. You can imagine what's going to happen when rates get down towards like that 5.25, 5.5, in that ballpark, right? And again, this is a good chart. This is based on NAR's data. Back in 2008, inventory topped out around 4 million homes for sale between both actives and under contracts. Right now, the most recent data that they put out, NAR, 970,000 homes active on the market, actives and under contracts to begin the year. Which again, is the second lowest of all time. The only time we've ever been lower was last year, last January, 2022. And the thing is here, remember, 2008, not only did they have 4 million homes on the market, this low-income population in Gen X, or some people say older millennials, those were the people who were 30 to 35 back in 2008. You're 40 to 45, you're 45, excuse me, to 50-year-olds now were the people who were 30 to 35 back in 2008. There was a big low-income population here, right? Now, up here, largest generation ever, millennials, those are your people 30 to 35 now. 3.4 million more people between the age of 30 to 35 now versus 2008. And we have about 3 million less homes on the market, second lowest inventory of all time. So the inventory story, it's going to be a story for the whole decade, unfortunately. It's going to be a tough market to be a buyer in. Sellers are going to have a lot of power this decade. Last thing I'm going to leave you guys with, what are some indicators to look for? Because, I can make predictions and say, I think this is going to happen, that's going to happen. But instead, I think the better thing to do is look for these indicators, right? Number 1 and 2 coincide with one another. When does the Fed pause? Because when the Fed does ultimately pause, those spreads between interest rates on 30-year fixed rate mortgages and 10-year treasury should come in. Right now, you're taking the 10-year treasury plus about 2.75%, and that's your mortgage rate. Historically, it's take your 10-year treasury plus 1.7%, and that's going to be your interest rate on your mortgage. When the Fed pauses, I'm not saying it's going to come, that spread's going to come all the way back down to 1.7 overnight, but it will slowly begin to come back in. That's number 1. And number 2 really combined, right? Number 3, and also I should say along with number 1 and number 2, when the Fed begins actively to cut, then that spread should come closer to 1.7. Number 3, what does core PCE, I should really say PC, look like over the next 6 months? As long as that continues to come down, and the next CPI reading actually comes out tomorrow on Valentine's Day. So when that comes back in, we could see rate cuts without seeing a recession. So pay attention to that and be a cheerleader for CPI to keep coming in lower and lower and lower and lower. We want to see inflation get crushed. We want to see inflation get lower and lower because that's going to be good for us as a whole, for interest rates going lower. Number 4, when do mortgage rates hit 5.5% or lower? We saw that when that happened back in August of 22. The sales pace, compared with the August 21 frenzy, was only 0.1% off. And sales went up 18.3% month over month. So again, that's a key indicator. When rates start getting towards that 5.5% mark, these buyers, I talked about all this crazy amount of demand built up on the sideline, good case to be made, they're going to come back in at that point in time. And number 5, how much does your market's inventory grow between late January and early May? Nationwide, the most amount of inventory increases, they come between late January and early May. So how high can inventory grow between late January and early May? If it continues to stay low, and again, you will always have that seasonal climb. Inventory is going to start growing soon. It has to. It always seasonally does grow. How much it grows is the question. If it doesn't grow as much as it historically does percentages-wise, that really tells you that, hey, Mr. and Mrs. Buyer that I'm working with, we might need to be a little bit more aggressive here and make more aggressive offers, because if we don't, we might be in a tough spot. We might be in a tough spot in regards to not being able to really ultimately get you a home. And obviously, you don't want to just not have a home to raise your family in or just rent forever, right? So we need to maybe be a little bit more aggressive on offers now, and keep in mind that, as an example, like Mortgage Bankers Association, you could show them that chart, has told you that mortgage rates, they're projected to go down to 4.4% by Q3 of 2024. And if that happens, then you refi at that point in time and your monthly payment goes down, substantially. But the whole key right now, we find a house that you like, let's get that house, because this low inventory environment, it's here to stay. You're not going to see inventory levels get back up anywhere close to what they were in 2008. Let's just hope we can get to 2019, because we're still 46% off from 2019. And remember, 2019 was a 4-decade low at that point in time. So with that being said, just want to thank you guys for taking the time to come out tonight and go over this. And hopefully you thought this was valuable. Hopefully you can use this with your clients and your business, whether they be buyers, sellers, investors that you're working with, so on and so forth. Hopefully you can use this to your benefit. I wanted to put my top 5 data sources up here. Logan Motoshami, he's great with Housing Wire. He's a lead analyst there. I have a Housing Wire subscription. I'm a fanboy for them. They're great. He's great. Very interactive. I love their data. I love the way they explain things too. They call balls and strikes. They have no bias. I love following them. Bill McBride, Calculated Risk Substack, really good. I think I pay $5 a month for that. Really, really good real estate data. Mike Simonson, he does a nationwide video every single Monday. He just put it out today, actually. If you go on YouTube and type in, Mike Simonson Altos Research, you'll be able to get that. Really, really good video. Really, really good content too. He also does individual markets too. So if you have an individual market, if you're in like, let's say Iowa, in Des Moines, and you want the real estate data for your specific market, he could do that for you. And he'll provide really, really granular reports. And they're forward looking too, which is awesome because you could provide insights, future insights to prospective people that you're working with. Jay Parsons, if you're into rental housing, he's a great rental housing economist. Super, super, super good. Wealth of knowledge, knows pretty much everything you need to know about rental housing. And last but not least, you saw me reference John Burns Consulting a number of times in this webinar. John Burns is great as well. His consulting firm, tremendous, really, really top, high quality real estate data. So again, just want to say thank you. Again, this is my info. If anybody has any questions, you could feel free to email me, kylekovats@gmail.com. I have 2 websites here, Kovats Multifamily. That is our syndicate business. Again, we buy apartment complexes. So if anybody ever wants to invest passively into an apartment complex and share in all the profits from it, whether it be cash flow, appreciation, depreciation, perhaps you could take advantage of that for tax purposes. I can't give tax advice, so I can't get into that right now. Feel free to email me and say, hey, add me to your investor list. I don't know if we'll get a deal this year, but if we do, I could certainly let you know. And then kovatschool.com. If anybody is looking to get their real estate license in New Jersey, we do online real estate school. It's all taught live. I teach, at least about half to 3/4 of the classes. So feel free to sign up, through there as well. Or if you know anybody looking to get their license, feel free to have them reach out to me. So anyway, with that being said, I'll open it up to questions now. I'll try to answer questions to the best of my ability. So if you guys have questions, certainly feel free to go ahead and type those in, and I'll get into those now.